Here is the overview of today's gold market news. Gold price movement and technical analysis. Impact of July jobs report. Massive global stock sell-off and market decline. Geopolitical risks in the Middle East. Here are the latest gold price movements and technical analysis. Gold is trading between the 20-day moving average resistance at $2,415 and the 50-day moving average support at $2,379. This range indicates ongoing downward pressure. A drop below the 50-day moving average could lead to further declines, with potential bearish targets. If gold breaks below the 50-day moving average and the recent swing low at $2,353, a declining ABCD pattern may be triggered. The initial bearish target from this pattern is $2,347. A further decline could see gold testing a secondary target of $2,311. A bearish breakdown occurred from the previous low of $2,370. A daily close below this level will confirm the weakness. Since hitting a record high of $2,431 in April, gold has been consolidating. Testing support around the pattern's bottom is expected. The extended target for the falling ABCD pattern is $1,312, which aligns closely with the consolidation pattern's bottom trend line. Key support levels are around $2,294 to $2,287. Falling below $2,294 signals weakening, and a decline below $2,287 confirms a bearish breakdown. If gold drops to the $2,312 target, it will be consistent with previous retracements of 6.7% and 6.3%. The 20-week moving average provides support just below the week's low at $2,353. It has acted as dynamic support for the uptrend since mid-October 2023. A decline below the 20-week moving average would lead to more selling. The extended target for the ABCD pattern in this scenario is around $2,266, which could serve as a proxy for the internal uptrend line. Let's have a look at the impact of the July jobs report. The July jobs report showed an increase of 114,000 non-farm payrolls, missing the forecasted 175,000. The unemployment rate also rose to 4.3%, the highest since October 2021. The disappointing jobs data led to a reassessment of Federal Reserve rate cut expectations. Prior to the report, it was predicted that the rates will be cut by 25 basis points in September, with potential additional cuts in November or December. Interest rate futures now suggest a 69% chance of a 50 basis point rate cut in September and an 84% probability of at least 100 basis points in combined cuts before year-end. The Federal Reserve Fund's rate target remains at 5.25% to 5.5%, the highest since July 2023. Despite the weak jobs report, some argue that the economic health and job statistics were not entirely weak, and the unemployment rate remains relatively low. Average hourly earnings rose 3.6% year-over-year, though less than the previous month. The JP Morgan Chase and Citigroup banks project 125 basis points of rate reductions by year-end, with 50 basis points expected in September, 50 in November, and 25 in December. Goldman Sachs has adjusted its rate forecasts in response to the market's volatility and economic conditions. The investment bank Morgan Stanley suggests that a soft landing economic outlook scenario, that lower inflation without a recession remains plausible, but the path is narrowing. Corporations face margin pressures challenges, global growth is slowing, and there is uncertainty around tariffs, taxes, and regulations. The high government debt at $35 trillion and a large Federal Reserve balance sheet at $7.2 trillion complicate monetary policy. Morgan Stanley predicts gradual and shallow rate cuts, with the Federal Reserve Fund's rate potentially reaching about 3.5% by early 2026. Morgan Stanley advises diversification and valuation, favoring the equal-weighted S&P 500 or high-quality cyclicals and defensives. However, investors should avoid small-cap momentum or overvalued stocks, such as those in the Magnificent Seven tech stocks. Next, let's look at the recent massive global stock sell-off and resulting market decline. global markets experienced a sharp decline, with Japan's stock market seeing its biggest single-day drop since 1987. The global sell-off, which began last week, has wiped out over $1.3 trillion in U.S. stock value and pushed the Nasdaq into correction territory. The sell-off is exacerbated by lower trading volumes typical of August. The Federal Reserve's decision to keep its benchmark interest rate at 5.25% to 5.5% has been seen as one factor that led to the sell-off. Investors are concerned that the Federal Reserve's reluctance to cut rates amid easing inflation and a weakening job market could lead to economic slowdown. The yen carry trade, where investors borrowed cheaply in Japan to invest abroad, is unwinding. The Bank of Japan's recent interest rate hikes and reduced bond purchases have strengthened the yen, prompting investors to back to yen. The Magnificent Seven tech stocks, which drove a significant market rally in the first half of the year, are now facing a correction. A rotation from tech stocks to domestic-focused companies and muted outlooks from major tech firms like Google, Amazon, Apple, and Microsoft have led to declines. Warren Buffett's recent sale of a substantial portion of his Apple stake has also added to concerns about overvaluation in tech stocks. The recent geopolitical risks in the Middle East have influenced the gold price's trends. Rising geopolitical tensions, particularly between Israel and Iran, are contributing to market uncertainty. Concerns about a potential escalation of conflict and its impact on global oil prices are influencing market sentiment. Recent events include the killing of Hamas leader Ismail Haniyeh and increased U.S. military presence in the region.